What if the value of your money was never real, never objective, never mathematical, but simply whatever a small group of unelected elites decided it should be? That single question has overturned empires, fueled financial booms, and quietly determined who becomes wealthy and who loses everything without ever understanding why. Because behind every currency, every crisis, every sudden shift in global wealth, there's a hidden architecture built by central banks, institutions that do not produce goods, do not run businesses, and yet hold the power to redefine economic reality with a single announcement. And the most revealing part of this system is not how it operates, but how invisible it remains to the public living inside it. For centuries, people assumed money had intrinsic value, that gold, silver, or printed bills held worth on their own. But the deeper you look into monetary history, the more you find a pattern of intentional design, where value is manufactured, adjusted, and weaponized to serve the interests of those close enough to touch the levers. Central banks were never neutral referees. They were created to solve political problems, protect government debt, stabilize collapsing markets, and, in the process, grant extraordinary advantages to a narrow class of insiders who understood the game long before the public realized a game was being played. Every major shift in monetary policy has enriched someone. When interest rates fall, asset holders grow wealthier, instantly. When liquidity expands, financial institutions receive the surge before the effects reach ordinary citizens. When inflation rises, debtors benefit while savers lose purchasing power overnight. None of these outcomes are accidents. They are engineered consequences of decisions made behind closed doors, decisions that ripple outward through markets, households, and entire nations. But here is where the real tension starts to build. The story of who gets rich from monetary policy is not a modern scandal. It is a historical pattern stretching back to the earliest central banks, from European monarchies financing wars to modern governments financing deficits. The mechanisms changed, but the advantage remained the same. Those closest to the source of money creation always knew how to position themselves before the public felt the impact. And if you've ever wondered why certain families, funds, or institutions seem untouched by crises that devastate everyone else, the answer lies in understanding how the system quietly distributes opportunity upward. You ever noticed how the biggest fortunes seem to grow exactly when the economy looks unstable to everyone else? Stay with this thought, because what you discover next may challenge everything you assumed about fairness in financial systems. Before we continue, share your thoughts in the comments, because understanding how monetary power actually works is essential today. Let me know if this opening provokes something in you. Like the video, check if you're already subscribed, and let's keep moving forward as we uncover the forces shaping what your money is truly worth, without closing this idea yet, only opening the path to what comes next. To understand how central banks became powerful enough to shape the fortunes of nations, you have to go back to the moment money stopped being a simple tool of trade and became a strategic instrument of political survival. Long before modern economists debated interest rates, on television, monarchs and governments were already searching for a way to control the flow of wealth without appearing to manipulate it directly. They needed an institution that could raise funds without public outrage, stabilize markets without admitting weakness, and create liquidity without calling it debt. That was the birth of the first central banks, and from the start, they were never merely financial entities. They were political inventions designed to solve crises that threatened the authority of those in power. The early central banks emerged not from economic theory, but from desperation. Wars needed financing, empires needed expansion, and treasuries needed an escape from insolvency. When governments could not borrow enough, they granted exclusive privileges to private financiers who agreed to lend vast sums in exchange for influence over national monetary policy. These alliances produced a structure in which public authority and private profit fused together, forming a pattern that would repeat for centuries. Every historical document from that era reveals the same underlying theme: control the supply of money, and you control the trajectory of a nation. Yet the most striking insight appears when you examine how these early institutions operated. They discovered that directing credit was more powerful than owning land or collecting taxes. Whoever controlled the creation of credit held the real leverage over monarchs, merchants, and entire populations. A kingdom could fall if the bank refused to extend new loans. A merchant class could rise if credit suddenly flowed their way. And when crises emerged, central banks positioned themselves as the only force capable of restoring stability, expanding their influence each time fear gripped the economy. The public narrative portrayed them as protectors of financial order, but behind that narrative, elites learned to anticipate political decisions by reading the movements of these institutions. Those who understood the mechanics of early monetary policy positioned themselves to capture enormous gains from currency changes, government borrowing, and the shifting tides of interest rates. What appears today as a sophisticated global financial system began as a set of improvisations meant to shield rulers from failure while enriching the intermediaries who made the rescue possible. This origin story reveals a pattern that still shapes the modern world. Central banks began as emergency tools, but every emergency expanded their reach. And as the structure grew more complex, so did the opportunities for those aligned with it. Understanding how this foundation was built is essential, because the next layer of the story exposes how policy decisions, once technical, evolved into engines of private wealth in ways that most people never imagined, setting the stage for what comes next. As central banks gained influence, something more subtle and far more profitable began to take shape. Monetary policy, once a tool to prevent collapse, evolved into a mechanism capable of generating extraordinary private fortunes with remarkable precision. The transformation happened quietly. Decisions that appeared technical on the surface, like altering interest rates or adjusting reserve requirements, started to shape entire markets in ways predictable only to those with access to the earliest signals. And when information moves faster than the public can react, the advantage becomes immense, creating a formula of invisible wealth accessible to a privileged minority. The turning point came when central banks realized that their communications held as much power as their actions. A single statement could move billions of dollars across borders within minutes. Expectations became a currency of their own. If insiders understood in advance how policy would shift, they could position themselves before the rest of the world even sensed a change. This ability to monetize anticipation created a quiet empire of strategic foresight, where wealth accumulated not through labor or innovation, but through alignment with the institutions defining the rhythm of global finance. Consider how liquidity injections work. When central banks expand the money supply, the new funds do not flow evenly through society. They enter the system at specific points, usually through financial institutions and asset markets, meaning those who stand closest to the source benefit first. Their portfolios rise, their leverage increases, and their influence over economic direction grows. By the time the broader population feels the effects, the early beneficiaries have already captured the upside. This sequence repeats across history, from the earliest note-issuing banks to modern quantitative easing programs. But the process becomes even more striking when interest rates enter the equation. Lower rates inflate the value of assets held mainly by wealthy investors, while higher rates often trigger liquidity shortages that open opportunities to acquire distressed assets at deep discounts. Those who understand how cycles unfold can profit during both expansion and contraction. This dual benefit structure created a new class of economic actors who no longer feared volatility because volatility itself became a source of gain. The deeper you analyze these patterns, the clearer the picture becomes. Monetary decisions, framed as neutral or necessary, often contain embedded advantages for those positioned to read the signals correctly. And these advantages compound over time, forming multi-generational wealth structures that appear natural to the public but are anything but. Understanding this formula is essential because the next chapter reveals how crises themselves became strategic tools for expanding influence, opening the door to a level of monetary manipulation the world was never meant to see, setting the stage for what follows. As monetary systems matured, a deeper pattern emerged, one that reveals how crises were not just moments of instability, but turning points that allowed central banks to consolidate even greater authority. Every era of turbulence, whether driven by war, panic, or economic collapse, expanded their mandate in ways that would have been impossible during periods of calm. What began as institutions meant to stabilize the financial system gradually evolved into architects of economic destiny, shaping the trajectory of nations through decisions made far from public view. To understand how this happened, you must trace the way fear reshaped the relationship between governments, markets, and central banks across centuries. During wartime, for example, governments needed immediate liquidity to survive. Traditional taxation could not raise funds quickly enough, so central banks stepped in as the ultimate source of emergency financing. They issued notes, purchased government debt, and flooded economies with resources that kept states functioning. And while this seemed necessary, each intervention expanded their influence. The more governments relied on central banks, the more authority those banks gained over national priorities. War did not merely drain treasuries, it shifted power toward the institutions that could manufacture money on demand. But the most revealing transformations occurred during financial panics. When markets collapsed and confidence evaporated, central banks became the only entities capable of restoring stability. By offering liquidity, guaranteeing deposits, or rescuing failing institutions, they positioned themselves as indispensable pillars of order. Yet with each rescue came new powers, greater oversight, broader regulatory reach, and deeper integration into political decision-making. Crises that devastated ordinary citizens often strengthened the very institutions meant to prevent them. Even the Great Depression produced a dramatic recalibration of monetary authority. As banks failed and unemployment surged, policymakers gave central banks unprecedented tools to intervene in the economy. These measures, intended as temporary responses, later became permanent features of monetary governance. The blueprint repeated in the late 20th century when inflation spiraled out of control and forced nations to centralize interest rate policy under technocratic institutions insulated from democratic pressure. Once again, volatility justified expansion. The 21st century added its own chapter. The global financial crisis and subsequent recessions allowed central banks to deploy massive interventions, from asset purchases to emergency lending facilities. These actions stabilized markets, but they also amplified the influence of those who could anticipate them. Investors aligned with policy shifts captured enormous gains as asset prices soared, while the broader population faced slow recovery and rising inequality. The recurring pattern is unmistakable. Turmoil enriches those who understand the architecture of monetary power and deepens reliance on the institutions orchestrating the response. This cycle of crisis and consolidation raises questions that deserve reflection. If historical shocks repeatedly strengthen the same centers of authority, what does that reveal about how the system is built and whom it ultimately serves? Share your thoughts in the comments, especially if you've noticed patterns in how instability reshapes economic power, because your perspective matters as we continue unfolding this story into its next layer. As the monetary world transitioned from metal-based currency to paper and eventually to digital systems, something fundamental shifted beneath the surface of global finance. Money stopped being a physical object tied to a measurable resource and became an abstraction, a promise backed not by material substance but by institutional authority. This shift was far more consequential than most people realize, because once currency was no longer anchored to something tangible, the power to define its value expanded dramatically. Central banks were no longer just guardians of stability. They became creators of economic reality, controlling the pace, direction, and structure of financial life with unprecedented freedom. The move away from the gold standard illustrates this perfectly. For centuries, the idea that currency must be convertible into precious metal acted as a constraint on monetary expansion. Governments could not issue endless notes without risking redemption they could not satisfy. But once convertibility was abandoned, first temporarily during wars and later permanently in peacetime, the constraints disappeared. Money creation became a political and economic tool shaped by strategy rather than scarcity. And those who recognized this early positioned themselves to exploit a system where liquidity could appear or disappear through decisions made in boardrooms rather than minds. This transition did not occur overnight. It happened through a series of calculated steps, each justified by the need to manage crises, stimulate growth, or protect national interests. The 19th century saw the rise of fiat-like practices. The 20th century formalized them. By the time digital money entered the landscape, the public had grown accustomed to a world where value was defined by decree. Yet beneath that acceptance, elites discovered new opportunities. When money exists primarily as electronic entries in financial institutions, its creation and movement can be engineered with extraordinary precision. Entire asset classes can inflate or contract based on liquidity flows invisible to the average citizen. The shift from metal to paper altered the structure of wealth. The shift from paper to digital accelerated it. Digital systems enable instantaneous transfers, algorithmic trading, and complex financial instruments that translate expectations into profit faster than any physical system ever could. But they also concentrate power. A small number of institutions gain the ability to monitor flows, anticipate reactions, and design policy tools that influence markets with remarkable subtlety. The distance between the decision makers and the public widens with each technological leap. This evolution also reveals a deeper pattern in monetary history. Every time money became more abstract, elites gained new leverage. Every technological upgrade increased the speed at which decisions could benefit those already positioned close to the source. And every shift allowed central banks to refine their control with greater flexibility, shaping not just markets, but the very perception of what economic value means. Understanding this pattern is crucial because the next stage of the story exposes how liquidity itself became the strategic weapon through which modern fortunes are built, carrying us directly into the next layer of this unfolding narrative. As modern financial markets expanded, liquidity became the most powerful invisible force shaping wealth, and central banks became the primary architects of that force. While the public often sees interest rates or inflation as abstract economic indicators, insiders understand that these levers determine who gains, who loses, and how fast fortunes can shift. A single policy adjustment can redirect trillions of dollars across global markets in seconds. creating opportunities so large and so sudden that only those prepared in advance can capture them. Liquidity is no longer just a condition of the financial system. It is the mechanism through which wealth is redistributed without ever appearing to move. The dynamic becomes even clearer when examining how central bank announcements influence asset prices. Markets do not wait for policy decisions to take effect. They react instantaneously to expectations, tone, subtle hints, or even the absence of expected signals. Traders who understand these patterns, or who can interpret the psychological cues embedded in official statements, position themselves for gains long before the effects reach the real economy. It is not the policy itself that generates the wealth. It is the anticipation of the policy, the ability to read the intention behind the language and act before the rest of the world catches up. But the most dramatic examples arise during periods of intervention, when central banks step into markets to stabilize them. When they buy assets, those assets rise. When they signal tightening, liquidity dries up and weaker players fall. And when they provide emergency lending, entire sectors can be rescued or indirectly rewarded. These actions are often justified as necessary to preserve financial stability, yet the benefits consistently flow toward the top of the economic hierarchy. Large institutions with access to sophisticated models and real-time data can absorb the impact instantly. Ordinary participants feel the consequences months or years later. Consider how asset inflation works under low interest rates. When borrowing becomes cheap, corporations and investment funds leverage aggressively, acquiring real estate, equities, commodities, and even distressed assets. As prices rise, their portfolios grow exponentially. Meanwhile, average citizens face rising housing costs, stagnant wages, and shrinking purchasing power. The same policy that unlocks extraordinary gains for one group quietly tightens the constraints on another. This divergence is not incidental. It is embedded in the structure of liquidity-driven markets. This pattern intensifies during periods of uncertainty. When fear spreads, central banks intervene with powerful liquidity injections that stabilize asset prices. But those already holding large positions benefit immediately, while those who exited markets out of caution miss the rebound. Risk shifts from the elite to the public without being recognized as such. And as cycles repeat, the distance between those who understand the system and those who simply endure it grows wider. These dynamics reveal a truth that sits at the core of modern finance. Wealth does not merely respond to policy, it is engineered through it. And the deeper you follow this thread, the clearer it becomes that liquidity is not just a financial tool, but a strategic advantage, one that shapes opportunity long before the public realizes a shift has begun, guiding us straight into the next revelation about how insiders win, even when the system appears unstable. If liquidity determines how wealth expands, inflation and interest rates determine how wealth is transferred, often quietly, predictably, and with effects that most people misunderstand until the consequences have already reshaped their financial lives. What appears to the public as a natural fluctuation in prices is, for those positioned closest to monetary power, a strategic moment where fortunes can be protected or multiplied with astonishing precision. Inflation is not simply too many dollars chasing too few goods. It is a redistribution mechanism, and the winners are almost always those who anticipated its arrival, or who stand close enough to the source of its creation to absorb the benefits before the losses spread through the economy. When inflation rises, the purchasing power of ordinary savers erodes. Their wages lag, their savings shrink, and their cost of living accelerates. Yet for leveraged investors, corporations with access to cheap credit, or institutions holding appreciating assets, inflation does something entirely different. It lifts the value of real estate, equities, commodities, and alternative stores of wealth. It reduces the real burden of debt. It shifts the economic landscape in ways that reward those who entered the cycle prepared, leaving the unprepared struggling to adapt. This asymmetry is not accidental. It is the predictable outcome of how modern monetary systems channel pressure downward while channeling opportunity upward. Interest rates amplify this pattern further. When rates fall, asset prices surge, benefiting the wealthy disproportionately. When rates rise, weaker firms collapse, opening opportunities for well-capitalized players to acquire undervalued assets at steep discounts. Even the timing of rate changes carries enormous strategic value. Insiders capable of interpreting the subtle cues in central bank communication can adjust their positions long before markets fully digest the shift. To them, monetary tightening is not a threat, but an entry point. Monetary easing is not relief, but a confirmation of expected gains. The most revealing aspect of this system is how predictable it becomes once you understand the incentives driving each decision. Central banks aim to stabilize economies, yet the tools they use inevitably create conditions where certain actors benefit far more than others. Inflation hurts wage earners but helps debtors. High rates damage speculative capital but strengthen disciplined long-term buyers. Every variable has both a public narrative and a private outcome, and the private outcome often accumulates in the hands of those who know how to interpret the deeper structure beneath the headlines. Across history, these mechanisms have repeatedly created cycles where elites shield themselves from the shocks experienced by the broader population. The same pattern appears in empire after empire, economy after economy. What changes is only the vocabulary used to describe the process. And understanding this recurring architecture opens a door to a deeper question about how economic power is maintained across generations. If any part of this resonated with you or reminded you of something you have observed in real life, share your thoughts in the comments. Your perspective helps expand this conversation as we continue uncovering how these hidden forces shape the world around us. As central banks grew more sophisticated, the most powerful advantage shifted from money creation itself to something far more elusive: access to information before the rest of the world knew what it meant. In modern financial systems, information is not just data. It is leverage, velocity, and profit wrapped into a single invisible asset. While the public interprets policy decisions only after they occur, a small network of institutions, analysts, and politically connected actors can often infer changes long before they become official. This anticipation shapes markets with extraordinary precision, creating fortunes that appear to be the result of strategic genius, but often originate from understanding how the monetary machine speaks between the lines. The language of central banks is a world of its own. A shift in tone, a softened phrase, the removal of a single word can trigger billions of dollars in global repositioning. Insiders trained to interpret these nuances react instantly, adjusting portfolios before mainstream analysts even publish their first interpretations. They do not need secret meetings or explicit signals. They need only to understand the rhythm, the psychology, and the incentives driving each institution. Once you learn how to decode these patterns, the financial landscape becomes less chaotic and more like a script unfolding in predictable sequences. This is why the concept of forward guidance changed everything. When central banks began communicating future intentions to shape market behavior, they unintentionally created an environment where those who understood the message deeply could profit long before the actual policy took effect. Markets began to react not to the present, but to the future. Prices reflected not reality, but expectation. And expectation became a currency of its own, traded, leveraged, and exploited by actors who mastered the art of interpreting subtle cues. But information asymmetry goes even deeper. Large financial institutions have dedicated research teams watching every economic metric, every speech, every geopolitical shift. Their speed allows them to reposition capital in milliseconds, while ordinary investors process the news hours or days later. When central banks release data, algorithms scan for meaning faster than humans can blink. Advantage compounds, not because of illegal access to information, but because of proximity to the mechanisms that generate it. In this world, even being early by a few seconds can translate into massive returns. Yet the most striking part of this dynamic is how consistent it is across history. From the earliest bond markets to modern algorithmic trading firms, those closest to the source of information have always dominated financial outcomes. The tools changed, the networks expanded, the speed accelerated, but the underlying pattern never shifted. Information flows upward first, profit flows to those positioned to receive it, and the risks spill outward toward the public only after the powerful have secured their advantage. Understanding this architecture is essential because it reveals how monetary influence extends far beyond interest rates or liquidity injections. It shapes the very structure of opportunity in the modern economy, guiding us toward an even larger question about how global coordination between powerful monetary institutions transforms markets on a planetary scale, which is exactly where the story continues. As global markets became increasingly interconnected, the influence of central banks stretched far beyond national borders. Monetary policy was no longer a domestic tool, but a geopolitical instrument capable of reshaping alliances, redirecting capital flows, and establishing hierarchies between nations. What many view as independent financial decisions are often part of a coordinated structure, where the major Western central banks move in rhythm, creating a unified front that determines the direction of global liquidity. And behind this coordination lies an unspoken reality. When the largest monetary powers align, the rest of the world must adjust or face destabilizing consequences. The alignment between major central banks is not accidental. It is the product of decades of integration within financial markets, shared institutional philosophies, and overlapping political interests. When one central bank tightens policy, others often follow to prevent capital flight. When one expands liquidity, others mirror the action to avoid currency distortions. These synchronized decisions create waves that ripple through emerging markets, commodity producers, multinational corporations, and sovereign wealth funds. Nations that do not participate in the coordination feel its consequences most intensely, as their currencies weaken, debt burdens rise, and investment flows evaporate. This dynamic became particularly visible during global crises, when the world faced liquidity shortages. Central banks in the United States, Europe, and key allied nations established swap lines that acted as lifelines for foreign markets. These mechanisms provided access to dollars and euros in moments of panic, stabilizing markets, but also reinforcing dependence on Western monetary systems. Countries receiving support had no choice but to align with the policies and expectations of those supplying the liquidity. Monetary relief became a form of diplomatic leverage, making the financial system not merely economic but geopolitical in nature. Even interest rate cycles demonstrate this structure. When the Federal Reserve adjusts policy, the consequences stretch around the globe. Higher rates strengthen the dollar, pressure emerging market currencies, and force foreign governments to raise their own rates to avoid capital outflows. Lower rates, meanwhile, flood the world with liquidity that fuels asset bubbles across continents. These effects are so consistent that entire financial strategies are built around anticipating shifts in Western policy rather than local economic fundamentals. The result is a world where monetary sovereignty is increasingly an illusion. Smaller economies are not entirely free to choose their policies. They react to the decisions of stronger players, often with little control over the outcome. And even within the Western alliance, there is an internal hierarchy. The institutions closest to the core of global liquidity creation wield influence that extends far beyond financial markets, shaping political decisions, trade dynamics, and international negotiations. This pattern, repeated across decades, reveals a deeper truth about the modern economic order. Power is no longer defined primarily by military force or territorial control. It is embedded in the capacity to create, manage, and manipulate the value of money on a global scale. And understanding this evolution brings us to a critical question. If monetary coordination has shaped the past, what happens when the system reaches its breaking point and the future of value itself comes under pressure, setting the stage for the final part of this narrative? As the modern financial system edges closer to a turning point, the question that quietly rises beneath global markets is not whether the value of money can change, but how dramatically it can shift once the public begins to understand who truly defines that value. For decades, central banks have managed crises by expanding liquidity, suppressing volatility, and coordinating policy across borders. But every intervention, every emergency measure, every round of monetary stimulus has carried long-term consequences that accumulate beneath the surface. The world now sits at a moment where debt is historically high, political divisions are deepening, and technological disruption is challenging the very foundations of financial architecture. When these pressures converge, the definition of value itself becomes unstable. Digital currencies introduced by governments are one sign of this transition. They promise efficiency and security, yet they also centralize monetary oversight in ways that could reshape economic freedom. At the same time, decentralized digital assets challenge the monopoly of state-backed money, creating tension between centralized authority and market-driven alternatives. Meanwhile, nations competing for geopolitical influence increasingly use currency strength, liquidity access, and financial sanctions as strategic tools. The battlefield of the future will not be defined solely by armies or territory, but by who controls the global channels of value creation. This moment reveals a truth that is echoed through centuries of monetary history. When the structure of value becomes uncertain, power shifts. And as the world moves deeper into an era defined by rapid technological change and fragile political alliances, the institutions that once dictated the terms of economic life may face pressures unlike anything in their past. Some will adapt and expand their authority. Others may lose influence as new systems rise. What remains constant is the role of those who understand these transitions early. They position themselves not just to survive change, but to shape the opportunities hidden within it. For the public, this shift often feels distant, technical, or abstract. But the implications touch everything: savings, wages, investments, social stability, and the ability of nations to navigate turbulent futures. The fortunes of central banks, once a subject confined to economists and policymakers, now shape the destiny of entire populations. And as the next phase of global transformation unfolds, the question becomes how societies interpret the moment when old structures begin to weaken and new ones fight to emerge. That tension sits at the heart of what comes after this narrative. If you reach this point, share a comment saying, "This message was for me," because it helps me understand how deeply this topic resonates with you. And if this exploration brought clarity or sparked new questions, consider subscribing so you don't miss the next chapter of this journey. A like on this video also helps keep this conversation alive for others searching for answers. There's another video right here that expands on the patterns behind economic power. So click and continue with me as we follow where this story leads next without closing the path we just opened.